My portfolio is burning ahead.
I don't know if it is
Are
Monday.
you getting nervous yet? Just consolidating my lead at the top.
11.45% is what it says on the Navexa scorecard, Drew.
All I need is Tesla to crack autonomous driving before the year is out.
Easy.
And that thing's going to the moon.
That's
Mate,
it.
do you reckon he already does go to the moon, doesn't he? What was I going to say?
Yeah.
SpaceX is pretty much going to the moon.
Yeah, true. Tesla down
Just like crypto.
20.5% for the everything portfolio. Drew's $10,000 portfolio that we're running in this year. It's the only one in the negative for Drew.
My only laggard. And everything also, all but one is up double digits.
Which is, what is that? That's the Yarrow X20
Yep.
Dion's fund.
Yep.
So that's a good mix. That's a good strike rate, Drew.
And diverse. Like
Tesla,
I'm not relying on anything big.
Because in your $10,000 portfolio, Tesla did you weight that? How did you weight that? I should know this.
I think I did bigger holdings I think it was like 10, 10, 5, 5, 5, 5, 5. That makes sense. Or maybe it was 20, 20, 5.
I can't remember the exact
Are you
mathematicals.
saying attribution means I'm probably further below?
No, I'm just saying that if Tesla's a big position for your portfolio here, it would be weighing materially on the performance. Because then if it went back to break even, if it's a bigger position, obviously you're going to inflect really high.
But I think I made a big bet.
Pro
Certainly
Medicus.
hope not.
Yeah, you should be happy with that, wouldn't you?
It's had a great result overnight, did it?
26% for Pro Medicus. Nvidia, not bad.
How does they get away with not putting an earnings outlook in?
Because they're elite.
If another company did that, like if a bank did that, they'd be sold off 30%.
Yeah.
They're like, oh, you're not going to make any profit. We're worried about where the direction of the business is going.
Look at this gross profit margin for Pro Medicus. Holy mother of God. That's, woo. Okay, what about if we do it in percentage terms?
What's the margin?
Oh, it says 99%, but that's a bit
Can I borrow your glass? Have we got the same prescription or just the same glasses?
Bailey Nelson, mate. We got exactly the same everything. You even copied my hair by going bald. So for everyone that's listening, I'm just showing the operating margins of Pro Medicus. The operating margins, which is another word to say EBIT margins or the profits of the business before you have interest and all that sort of stuff and tax. 67% EBIT margins.
It's nearly as good as NVIDIA.
Well, let's actually compare it to NVIDIA here on the ticker terminal, which is the best terminal in the business, by the way, people.
That's why they managed, a 40% jump in profit in the last year. And what happens is they've got, what do they say, 520 million in new contracts, I'm guessing annualized contracts with US healthcare providers. But when you've got a scalable software-driven solution, your earnings margin can actually increase as opposed to even remaining flat.
I'm old enough to remember when Pro Medicus had like
negative margin,
single-digit annualized revenue.
Yeah, and then you compare that to Woolies, like the difference in businesses. Woolies' operating margin is like 6%.
Yeah, if they're lucky.
And this is like a 70% operating margin.
So there you go. Pro Medicus's operating margins are better than NVIDIA's. Basically 70% for Pro Medicus and 62% for NVIDIA. Holy macaroni, you guys.
I just happen to have both in my portfolio. Yeah. Credit to me.
Credit to you. That's a really high quality bet there. You can get the ticket terminal, by the way, peeps. We're going to be doing some episodes with the ticket terminal soon where you can analyze any type of profit margins or valuations through time. It's super handy. And now you can do valuations. All right, actually, let's do a valuation on the fly here, Drew. For anyone that's listening, I'll talk you through it.
PE 120 times.
So let's create a new model for Pro Medicus. Let's call it PME. So this is where you can value a company just using like all of the fundamental data that's already available in ticker. How much do you expect revenues to grow per year through 2028, Drew? And this is for Pro Medicus. So Pro Medicus historically, or this year, grew at 29%. Over the last 3 years, has compounded revenue at 33%. Over the last 15 years, Pro Medicus has grown profits at a compound rate of 17% per annum. Wowza. What do you expect it's going to do for the next 3 years?
Say 25%.
Yep.
Seems fair.
What do you expect operating margins to average throughout that period? So, yeah, as we know, high 60s.
Just consistent.
69?
69.
What do you expect the PE multiple will be when you sell Pro Medicus in the future? Its current price earnings multiple is 200. Its 10-year average is 97.
150?
150. 150 times profit.
This is the thing about single input modeling. It's like, what am I? It's more 150 to see what that looks like.
It's about fair value.
Oh, that's good. Which means you could justify buying it at the moment.
You could probably justify buying it if you assume it's going to stay at 150 times earnings.
Yeah.
Which actually is not,
or your
that's
earnings
actually pretty reassuring for me. Disclosure, I own Pro Medicus shares and I'm a very happy shareholder. So I'm actually surprised by that.
And then if growth is more than that, then there's every chance it is. If they keep winning these contracts and expanding, your margin could actually increase and your growth could increase at the same time. And the multiple matters less if that's the case.
Yeah, bloody oath. It's you can do an advanced model, Drew.
My share's down today.
This is trailing.
Up 6%.
So you can actually...
I'm on a heater.
This is actually super cool. I know we're talking about the ticker terminal right here, but you can actually input the exact P&L into the future. So you can pick what it would be. You can do comparables. It's pretty bloody cool.
Yeah, go on to those spreadsheets.
Yeah, you just wouldn't use a spreadsheet anymore. You just save your valuation models in there. Anyway, let's get back into the land of living. Drew, you own 5 or 6 private businesses. I can't remember how many. Partly owned,
yeah. Some passive, some active.
Meaning that you work in them, some of them you don't?
Yeah.
Okay, how are they performing?
You'd be naive to think that they're all performing well.
Okay.
Let's be completely honest.
Okay.
And then what's your assessment of performance?
Is Waddle the crown jewel? Do we have favourites or no? We're not allowed to say that.
Yeah, we do have favourites. I mean, I'm a financial advisor by trade, career, experience, and like yourself, why you probably entered into it is because I enjoy helping people. So
yeah, so you've got a soft spot for that.
Yeah, exactly.
Okay, if you could sell them all for 10% more than fair value and buy public companies, would you?
No.
You prefer to hold the private companies. Why?
You're going to sell all of them? Can you sell part of them? Or some of them, not all of them?
Yeah. I mean, you can, yeah. But I'm trying to get at how, I guess the origin of this question is how much do you value owning private businesses versus public businesses?
I think the ability to work in and have an influence over and an impact on a business and change its direction. And I think that's where the value comes from. I mean, definitely 5's probably too many.
Yeah.
If you're trying to be involved in them. But I think I see using share markets as kind of investing for the future. And that's something you do at some point. I think for me, at some point in the future, I probably would like to have more listed investments in, if you call it my portfolio. I don't really think about it as my portfolio. I think about it as my businesses.
Yeah.
But it would be nice to have optionality and other things around, not just the ones that I work in.
Yeah.
And the ones that if they run out of money, I have to put more money into.
Yeah.
That's the problem with running your own business.
Yeah. I mean, it's just a little thing called money pit.
Like a renovation.
Even worse than a renovation.
You've done a renovation too.
Yeah, I DIY'd that one. Probably not a great thing to do either.
Standing up to the test of time.
Well, kind of. The floor's a bit creaky all of a sudden. So there goes that. No, that's really interesting. No. Not for...
What's your asset allocation, private versus public?
Well, if you took the actual dollar value of it, it'd be like 90-something% private, wouldn't it? Like, it depends how much you'd value Rask at. I don't know what you'd value it at. Don't know. Equity might sell for a pretty penny, so maybe.
Yeah.
I don't know. Good on them.
It's a natural thing when you're in business. And then that's why I think we meet a lot of clients who have sold businesses.
Yeah.
And that's why it becomes so difficult. You watch their mentality when they go from having a business, selling it for a reasonable amount that they can retire on, and then putting that into a volatile market. And it's natural that they prefer illiquid things. Like if you go to a big financial planning private wealth firm, they'll use a lot of alternatives because they're not volatile. And when there's a sell down, the clients don't see this massive amount of volatility and feel like they have to sell. Like I couldn't have seen it worse. My dad invested immediately before the GFC hit. He sold his business, went into markets and saw 40% decrease. That was the most uncomfortable period.
Caught up with Scotty Carmichael from
beautiful
Escala Partners this week.
Lovely
and he
guy.
was saying that because he deals with a lot of high net worth families and stuff, and he was saying that one of the first things they do when they have a business owner that cashes in is they put him into fixed income.
Yeah.
Because they go, how could you go from being, he goes, how could you go from being a professional business owner for years in an industrial business to then being an investment manager with tens of millions of dollars?
Yeah.
He's like, that's a totally different skill set.
That's scary.
Yeah. So start with the safe stuff first. Yeah, for sure. Yeah, no, he was great to catch up with. But I think that's true. I think a lot of business owners fail to prepare. I was chatting to a guy named Lee Gant this week. The episode will be out soon on private and public markets, and he was saying that we referenced some research that said that approximately 70% of SME business owners, small and medium business owners, are wanting to exit in the next 10 years.
Yeah.
Only 1/3 of them have taken any action
to do that.
to do that.
Well, it probably takes 2 or 3 years to get a business ready for sale.
Absolutely, it does.
To line everything up, to probably get a bit of extra growth in there, all those sort of things, to get the best price anyway.
Yeah, imagine if you could get, so this is a good understanding of how valuations work in general. So everyone listening and watching, we just looked at Pro Medicus's price earnings ratio, which is 200 times.
Yeah.
Right? Imagine if you could increase earnings by $1 million. Effectively, what that means is you're going to get $200 million more when you sell.
Not many groups paid 200 times earnings.
But for example, if you could spend the next 3 years on your business, growing profits $500,000, if you're going to get paid 3 times your profit, that's pretty common.
It's extra 1.5 million in.
Yeah, it's extra 1.5 million. It's not $500,000, it's 1.5 million.
Yeah.
So a lot of business owners should really heed our advice and start planning many years in advance. Sure. Funk on Crack just wrote into the show. I just thought I'd answer this question at the top of the show, Drew, because it's a good one for you. We can only offer general financial advice only here on the podcast, by the way. If you do ask a question, please do not act on it until you've spoken to your financial planner, like say Drew here, because we don't know all of those other variables in your life. We try and get funny question names just to keep it more anonymous. Past performance is not indicative of future performance. Read the PDS and FSG that's available on the Rask websites. Funk on Crack asked, is 2 ETFs enough for a diversified portfolio? Drew?
No.
Okay. Why not? Why not just buy one of those VDHD things?
Yeah, you could say it depends, but you buy 2 ETFs.
Anything, to be honest. Yeah.
It's anything. Yeah, you could say it depends on anything. Any question I get, I feel nervous saying it these days. So I think someone is going to go, that's not an answer. I think it's like you'd be getting naive diversification if you're buying 2 ETFs. Even if you bought VDHG, you're getting an index exposure to essentially 3 asset classes: Australian shares, international shares, and some cash.
Yeah.
And it might feel like it's diversified, but it can depend on what your objective is. If you're happy to just deal with whatever the market gives you, I'm not happy with that. I want to be smoothing the ride more so, and have the potential for better than market returns, which means you have to have the risk of worse than market returns. Then you're just buying a highly concentrated portfolio, and it's quite naively diversified. It's a good starting point. There's nothing that says you can't buy these highly diversified as your core and then build around them slowly. Not everyone can afford to go, here's 10 ETFs and start investing in all of them at the same time. Yeah.
No, that's fair. I don't feel like it depends. I think if you just, I know, wash your mouth out with soap.
You're going to be talking about retirement mistakes next.
Actually, when I was younger, I had a bit of a potty mouth. And all
right? Yep.
Yeah. When I say younger, I mean 10 minutes ago before you record. I remember having my mouth washed out with soap a few times. Did you ever have that? You're a bit of a goody two-shoes.
Yeah, only once, I think.
Yeah, it was not a good experience for anyone that has been there and done that.
Maybe the wooden spoon. Every now and then.
Yikes.
Yeah.
Bring back the good old days.
No, do not. Do not.
That's how kids used to be.
Have you heard the new parenting? Yeah, what's your parenting approach? I'm interested to know about that too.
Yeah. If you can't walk at 12 months, don't even bother.
What's it called? The F around and find out. Have you heard that? That's a new parenting approach.
Yeah. Well, I guess some
serious.
People. Well, I'm not that kind
FAFO is a slang phrase.
Really?
But no, that's the wrong one.
Oh, okay.
But there is apparently on Wall Street Journal, not Urban Dictionary.
That's a reliable source, yeah.
Internet calls it FAFO style of parenting, child ruling that elevates consequences over gentle reminders when someone's doing something wrong.
All right. Okay.
Is that your approach? Is it also your approach to management?
Sounds like alpha dog training, to be honest. But Yeah, I don't really have an F around and find out type of approach. I don't like to. I'm pretty non-confrontational, Drew.
Yeah, I've noticed.
Yeah. But then it just kind of just, it all comes out of me at once, and I'm just like rage. No, I'm kidding.
Keyboard warrior.
Yeah, that's it. I don't really have an approach, but my approach would be pro-investing, kids pro-investing.
Yeah.
I just invest in them for the long term, invest in them in any way, so then they can understand the value of that as well.
You've been running Rask Advice now for how long?
Oh, you're going to ask me these questions, are you? Yeah. 4 months, 3 months, 4 months, yeah.
What have you learned? What's the biggest takeaway you've learned? Could be about advice, could be about yourself, could be about business in running a financial advice business. You can have two. It can be a two-parter if you need it.
This is a two-parter. I can't remember, because you did ask me this the other day and I can't remember what I said, but I think there's been a few things. Is financial advice is obviously complex.
Yeah. Even more. The regulatory and
environment.
the red tape and that.
Yeah, so it's
and the ingrained complexity.
Oh, that's right. That's what I was going to say. So the way for anyone that's not in financial planning to think about this is like, think about like all the regulation that's like a doctor would go through. But you're in an environment where it deals with money, and it's just even like there's even more skeptical people out there. So a lot of consumers are skeptical of financial planning, and then you throw into that all the compliance. And I think I tried to frame this to you the other day when I was messaging you. It's like, I think I've figured out why the cost of advice is horrible. I always knew why it was bad, but now I know exactly why it's bad. It's because most people in finance haven't actually read the law and understand what they can and can't do.
Yeah.
Most financial planners, as we sit here in 2025, understand there's something called FASEA, which is code of ethics, basically. And they basically outsource all their code of ethics to whatever the FASEA thing says. And so the financial planners who don't actually read what the law is then rely on compliance people who do read the law but have no connection to the client. So their only incentive is to just take no risk.
Mitigate risk, yeah.
Yeah. So their only incentive is take no risk. The financial planner wants to do the best thing for the client but needs to defer to these people for the compliance. And then what the ultimate outcome is for the consumer is they only get whatever the compliance person says, and then sandwiched in between that is some advice. And that's why you end up with this financial plan or a statement of advice 60 pages, is because at least half of it is just covering their ass.
If this
happens, then that. If this happens, then that. 5 product comparisons for the sake of it. We've tried to simplify that.
Yeah.
As much as possible, and that's been pretty rewarding. But I would say overall it's been positive. One thing that has been funny, I was saying to you this the other day, we encourage people to meet with a couple of financial planners. I'm sure you do too, and you see this a lot. So if you would think about it, if an average person that wants financial advice goes to 3 people or 3 firms and does a free call or whatever. It's not always free, by the way, people, but say it's 3 call. That means on average, a typical financial planning firm should have a conversion rate from client interest to becoming a client of 33%.
Yeah.
Ours is way higher than that. So I would suggest that we're capturing a lot of, we're doing well at the front end, and we're capturing a lot of clients. I mean, we're still quite cheap with our financial advice. Like, cheap, that sounds bad, but we're still on the lower end of pricing.
So good value.
Good value. We're Costco.
Yeah.
We're not Aldi, we're Costco. And
there's a little Costco hack too, wasn't there, about the pricing? Did you read that the other day?
No. No.
Like if it's 99 cents, it's on special sale. Like the ending of it.
Oh, really?
Something secret. Yeah, apparently.
I went to Costco on the weekend, had 2 hot dogs. Can you tell? But yeah, Costco is just a wonderful business. Let's not bring that up again because I'll just keep going. But yeah, I would say those are the things. So compliance, people wonder why the cost of advice is so high, because the financial planners are scared and the compliance people take no risk, naturally. As Charlie Munger said, show me the incentive. And I would say secondly is that I would probably just say to everyone, don't reach out to a financial planner and go through the whole process unless you're committed to getting advice.
Yeah.
Because it does take a lot of our time to do that. And we want to deliver a good service. I don't know. Have you got any learnings about financial advice over just say this year? You've been doing it for a long time, but 2025?
I think it's very similar that the generations, and Jamie and I were talking about this before. One part of it is a lot of the advisors now are younger. They're in their 30s and 40s like us, and a lot haven't had the experience of real market turbulence or crashes. So that's kind of one that's interesting. And a lot of the investors coming in also haven't had that. They started after the GFC.
Yeah.
So I think there's a kind of lack of that experience. And I also think it's the same thing. You might call it bedside manner or something like that, where it's a constant reiteration where we worry about giving good advice. And I think you do the same. And it's stop letting things get in the way of providing good advice. Legislation, obviously, regulate and disclose everything, but don't get in the way of good advice. It seems like we tend to sometimes get in the way of ourselves and being able to deliver it.
Yeah, it's like if you went to the doctor and then they did 5 other things before they actually told you the answer.
Yeah.
And that's what it's like in finance, and a lot of people find it. Interestingly, on the client side, I mentioned this to you the other day, our younger demographic clients, when they come to get advice, they're
done
in the door.
Yeah.
They are here, advice. I came here to do this 40-minute call with you, Owen, because I'm ready for advice. Stop holding me up. Let's do it. Whereas a lot of retirees way more apprehensive and probably have a few more scars from dealing with things over the years. So I totally get that. But the younger demographic, and by that I mean probably anyone under 45 is just like price, cool, done.
Yeah.
Very trusting.
Yeah.
So a bit different, but it's been a good experience. We're still learning a lot. What's your wait time at Waddle?
Wait time for a statement of advice?
For example, I rock up to the Waddle Partners office today and I'm ready to go ahead with whatever you've got a proposal.
So it's very quick, basically anyone that reaches out where they're getting contacted and usually a phone call within 3-4 days.
Yeah.
If not same day, whatever we can. We're trying to change that at the moment, opening up calendars and making it similar to yourself where you're able to book in. It's the delivery of the advice, and a part of that can be driven by the ability to access information that we need for that advice. And a part of that is accessing too much information. But in best cases, we're doing it. But you'll get your financial plan about 4 weeks from when you've signed up for it. But in worst cases where it's hard to get information, it goes out. It can be 6, 7, 8 weeks for the entire process. And then you think about, if you're opening accounts, you're setting up ongoing managed, these things you can drag, but not just because of us, but because of all the institutions. Every platform's different. Every fund manager has a different form. Every transfer, every industry fund, there's all different processes. Nothing's consistent. I'm not sure if you saw this is probably a bit too financial plannery.
Yeah, we're talking a lot about financial planning. We'll get on with the actual stocks and investing in just a second, but go on, I'm interested.
But have you heard the opt-in, the consent forms?
Oh, the new thing?
Yeah. ASIC, they changed the legislation, and then you had to have, so when we ask for your agreement to charge your fees, it has to have the account number on it. But when we first set up account, we want a contract as soon as we agree that we're going to work together, but we can't get an account number until the account's set up, and that can take 6 weeks, and then you're in breach because you haven't got it. How do you it's so counterintuitive.
How do you
That's
actually
my bugbear anyway.
How do you provide the service when you can't have the account because you can't act on their behalf?
Yeah, exactly. It doesn't make sense. But to more fun things, interest rates were cut.
Interest rates
must have been a relief.
Yeah. Oh,
you 72 townhouses.
Oh well, yeah. I was just going to buy a house in Toorak actually, 90% loan.
And more coming.
Well, they say.
Yeah, they say that all the time.
So according to the RBA rate tracker, it looks like interest rates are on the way down further. Did your old mate, Dr. Andrew Dermot, did he predict this?
He did.
He did, yeah.
He was asked earlier this week what his call was. I said a rate cut, 25 basis points, no more than that.
Okay, well, there you go.
He was also wrong the following month, the previous month.
As in previous years. So, by January 2026, according to the RBA rate tracker, interest rates will be 3.22%. So what that means in English is if you assume a bank makes 2% profit margins, your interest rate is 3.22% plus 2%. So by the end of the year, you should be paying 5% or less on your mortgage. And then by this time next year, Drew, the market suggests interest rates will fall to 3%. So still quite a way to go down.
Like 1.5 and 2.5 more rate cuts.
Yeah. I think that I was
showing 3.6.
Showing to Pete Wargent this morning for the Australian Property Podcast, and he was suggesting that we're getting some labour statistics and some different things out. It could quickly unwind. I actually think the risk here is the opposite. So I don't know what you think about this, but one of the things we spoke about at our investment committee was I actually think that there's a risk that we get inflation come back.
Because of tariffs or...
Yeah, because of the tariffs, because of a lot of property wealth, a lot of people spending again. I actually think you would expect that interest rates go down so inflation comes back. That's the natural cycle. But I actually think there's a risk that interest rates don't fall as far as people think.
Yeah, I think that's when we look at portfolios, we're kind of still balanced between fixed and floating rate fixed income.
Yep.
Because I think there's still value in having a hedge against falling interest rates. So a fixed rate government bond to make sure an increase in value if interest rates fall, even slightly, but it gives you a fixed return.
Yeah.
And your floating rate falls if interest rates fall. So we're still mixed between the two and evenly mixed between the two, which suggests some fall, but it's not going to drop to 2% or significantly in the next couple of years.
Yeah, we use the PIMCO Global Credit Fund for that. It's an ETF form now, PCRED, PCRD. Sponsor of our retirement podcast.
PCRED, all right.
PCRED. Yeah, well, so that yield is 5 to 6% floating, mostly, is credit. That's our best floating exposure right now. We've obviously got, we got like the Australian version of a treasury security, which is MMKT. We've got AAA from Beta Shares. What else do we own? On the fixed side, we've got IAF, the iShares. Yeah, PCRD. Sorry, what did I say?
PCRED, but you just added one letter.
Then we've got VAF. No, sorry, not VAF. VBND, the global bond. So we've got Vanguard Global Bond fixed, Australian bond with iShares fixed, and then we've got PCRED, MMKT, and AAA. Yeah. That's the mix. I did throw a bit, I don't know if you saw this, but I threw a bit of, we took a leaf out of your book actually with our recent portfolio changes. I chucked a bit of CLW, a bit of Charter Hall Long WALE REIT.
It's been on a nice little run lately.
Yeah, it has. Do you think that, so Charter Hall Long WALE REIT, for people that don't know, is a real estate investment trust?
Yeah.
CLW is the ticker symbol. It's here on the ASX, according to the Honourable Google Finance, which as we know is always correct. 5.57% is the yield on this puppy. It's a property REIT, so it invests in like commercial properties, like offices like we're in now, warehouses, service stations, all different types of things.
And long WALE means very long lease, so
very
average 9 years, where most tenancies are like 4 to 5 years in an office.
Bloody hell signs a 9-year lease.
Service stations and bottle shops.
But can you imagine signing a 9-year lease with fixed rent increases? Oh my Lord.
You might break don't break the sentiment. It's been positive lately.
Shoot myself in the foot rather than do that, honestly.
But 9-year lease and 90, in fact, I think some leases are actually 15 years and the lease expiry is 10.
I know the ATO and the government agencies love stability with their buildings, but like honestly, if you're a business.
99.9% occupancy.
Bunnings has long leases because obviously they can't just move a Bunnings out of the building that they're in.
And they put that into a trust as well too.
Yes, the BWP trust.
Like some support.
Yeah, but Charter Hall Long WALE REIT's been on a tear since what? Basically since July. It was down at a low of about June. It was $3.20. It's $4.50. So I'm quite tidy with that one.
You got the NTA.
You own that though, don't you, in the Waddle portfolio?
Yeah, we've owned that for a while on the basis that it was trading below its net tangible asset value.
Yeah. But that's a good example of how if you were dealing with a new client that's never experienced a stock market before, look at that thing. It's bouncing up and down all over the place. You don't have to buy the Charter Hall Long WALE REIT ASX CLW. You can just buy the Charter Hall Long WALE Fund.
Yeah. And
just go to the Charter Hall website and invest in it.
Yeah, exactly.
That way you don't have to worry about the share price going up and down because they don't do that.
But you don't get the discount. So the NTA is now $4.59.
Yeah, wow.
So it's getting close to its NTA.
Yeah. So
but it was always $4.59.
Can you explain for the folks what that means?
So your net tangible asset value is if you were to sell all those properties, what's the valuation of all the underlying properties minus the debt, basically?
Yep.
And that's so for each unit they have attributed a value on the latest valuation, proper valuations of $4.59. Okay. And because it's listed in the same way like a listed investment company, unless it's one of the big ones, can trade at a discount, your net tangible asset value is the value of all those underlying shares within a listed investment company.
Yeah, okay.
In this case, the gap's closed. So one reason we like this at the beginning was the fact that we were buying it in the high threes, and you're buying it like a 30% discount to the value of the underlying assets. So you're either saying we're buying it cheap or we expect the value of those assets to fall. And it can be a combination of both. You're buying it slightly cheap, the assets fall a little bit, but you make up 20% on the way along.
This is like that for anyone that's like not 100% sure. This is where we say in finance, you buy $1 for 50 cents.
Yeah.
That's where this comes from, this idea that you can buy something for less than it's worth. And this thing, as we can see here in the ticker terminal, this chart measures the price, the share price to the value of all the properties inside. And if you think about that, a level of 1 would mean that the value of the properties are equal with the share price. So that's through the center of the chart for people listening. You can see it in 2020, the price of offices went way up. People were overpaying for these assets. COVID hit, it fell off a cliff, and then it's continued to fall until the bottom of 2024, and it was at like half. 50 cents.
Yeah, that's when we were buying.
There's $1 for 50 cents, and now it's back near a whole dollar. So even if the value of the properties don't change, you're benefiting because the sentiment has come back.
Exactly.
Yeah.
And then we've done the same
you get a dividend
with,
along the way. You get a great dividend along the way.
It's been good. And now if it was 5% now, man, you can imagine what we were buying that before.
Yeah, probably. Wouldn't that be?
We've done it with
closer
rural
to 10%.
funds management. So you had RFF.
Yeah.
We've done it with Vicinity as well.
Yeah.
You can find these kind of discounts. There's no guarantee that the discount closes, but it's more likely, I think, in a property trust than it is in a listed investment company. A lot of cases.
For sure. Yeah. They always, because there's a lot of fees and people don't really understand how REITs make money, so they don't really care. I'd say this here with Charter Hall Long Way REIT. This is a really good example of how you can have, if you're like a traditional passive investor or something like that, you can get really good income from properties using the stock market.
Yeah.
This isn't the only one.
And that's, I meet a lot of people who, like clients who come in and go, oh, well, I want to invest in commercial property. I'm like, well, why would you go buy one property for $2 million when you can put $2 million on 10 of these and that has 500 properties in it?
Yeah.
Yes, you're dampening down the
potential
upside.
That's the point, right? Imagine you could buy a commercial property for half of what it's worth.
Yeah.
That doesn't happen.
You can't get that, yeah.
But here in this stock thing, you can do it.
Yeah.
So,
or a shopping centre next to it, or a toll road, or a
Centre Group, Westfield, that sort of stuff.
Say Seneca?
Centre Group.
Yeah, Centre, yep. Right.
But it's spelled, I can't believe how they spelled that.
Shopping centre.
SCENTRE. Centre.
Like a shopping centre.
Okay, I got it now. Bumper profit from CBA. Shares fall 5%. And that is good news for Drew and I because the community portfolio, Dizzy Rascals owns CBA, and it is now only up 12%. So thank you to everyone that recommended the community portfolio by CBA as the same with Vulcan.
You might Stephen Bradbury this. Everyone else might fall over and you'll just fall into the wind.
You know, I've actually been laying awake when I've got my 3 hours of sleep each night this week. I've been thinking, will I actually be able to catch you? I actually don't think I'll be able to. Do you know why?
Because NVIDIA and Microsoft are the key drivers of your...
So my kind of like nitrous oxide that I'm going to try and pump into the car on the straight is GGUS, which is a leverage ETF. But all of the shares inside of that are Microsoft, NVIDIA, Tesla, these types of shares.
Yep.
Which you already own.
I trumped you. And by having literally trumped you. Yeah. If I had, so basically because I've got 3 times as much leverage as you.
Exactly.
2.5 times.
So you've got more leverage by having 3 stocks versus my 2 times leverage GGUS.
But my risk is like if one of them turns, you could still win.
Yeah.
If Microsoft goes well, but NVIDIA turns significantly, well, just hang on and hope.
I'm going to have to write a complaint to Navar from Navexa. He's got my bloody IXJ ETF down 4.66%.
Are we going to?
I've been trying to tell him to
record on New Year's Eve as the market closes.
Yeah. Happy New Year. Yeah. Who wins? What do we lose?
I can't remember.
Okay.
I mean, James O'Reilly owes me a lunch if CBA keeps. I mean, I think I'm still ahead, but it's getting a bit close now. It's getting a bit uncomfortable. I can only do so many lunches though. So
true.
You tell me.
Okay, I'll come up with something. CBA, buy, hold, sell.
Hold.
Oh, really?
Not selling yet. I'd be comfortable holding. Like it just delivered a pretty solid result. I put an article up on Golden Times, I think this week. Which
is that P. Diddy's website?
Yeah. All right. Well, I mean, my nickname is D Mitty from back in the day, so who knows? But I was commenting on CBA. I'm like, yeah, they said the result was clean. What do you? I don't know how you do.
Maybe I'm thinking R. Kelly.
Yeah. You are. For those born before after 1995, 2000, I don't know, you probably wouldn't get it. Know these people, so good for you. But like, and it's like, I was clean, but it wasn't, a standout. I'm like, it's 12% of the ASX. It's one of the biggest banks in one of the hottest, most competitive home loan markets in the world. And it delivered a jump in profit, like a reasonable jump in profit, a record profit, falling costs, improving net interest margin. All of it was like, this is a pretty good result.
Yeah, but it's at like 30 times price earnings ratio.
The business justifies being the most expensive bank in the world.
Oh, yeah.
Deposit base, technology. It just did a partnership with OpenAI. It could be, who knows what it actually turns into. But no, none of the three other banks have done partnerships that look anything like it. They're ahead of the curve in Australia.
Yeah, it's fair enough. It is a good bank.
You said they'd gobble up two of the others if you're allowed to.
Yeah, it's fair enough. I'm sure the people at NAB would be very happy if CBA got them off MS-DOS.
Anyone born before 2000? After 2000, yep. MS-DOS.
Legit though.
Did you hear Futureproof has...
It's a finance festival, yeah.
Yeah, is it Bush performing? They always get like a...
Oh, really?
Yeah.
They had Redman last...
Method Man,
yeah.
And Third Eye Blind.
Yeah. Classic.
That's what I want to... there has to be a Rask festival.
With that
and we have to
ilk.
get like the 90s, like the top 100 Triple J Australian songs came out, like Grinspoon.
Oh, there we go.
Frenzal Rom.
Yes.
I reckon you'd pull those out.
I reckon we could do it.
They'll come out.
Yeah.
Reach out
watch the space
if you've got connections from those bands and you want to...
Yeah. So on the CBA front though, interesting. I was chatting to Cameron Gleeson from Beta Shares, disclosure sponsor of our finance podcast. He was sitting here this week. He came down from Sydney.
Did he also have a remedy Sodally?
No, he did not. Sodally. Is that what that is?
Yeah.
I've heard a lot about that. Don't know much about it.
Apple cider vinegar.
Yeah, I'm not that cool. Drew's also got his shacket on today for anyone that is watching.
Shut up.
So this ETF launched last week, HYLD, which is their competitor to VAS.
VAS or no?
No, it's VHY.
VHY.
So this is effectively...
It's like a showdown in ETF world.
Well, think about it.
Everyone's trumping each other.
Think about it. In the last week, we've had A300, which is just a direct competitor, lower cost to VAS.
And A200.
And A200. And now we've got HYLD, which is going straight for VHY. And they've already got BGBL, which took on VGS.
Does everyone just not like Vanguard? Is that the thing?
Well, I don't know. I always thought that Vanguard would win everything, and they are winning a lot.
Yeah.
But I almost think that I always thought, how could you beat a company that's effectively not for profit?
Yeah.
But what I forgot is because Vanguard hasn't innovated, it doesn't offer thematic ETFs. It doesn't offer all that stuff.
They tried active and shut them down.
It doesn't have any budget to go and invest in like the next wave of things.
Yeah.
And that's why I feel like these ETF providers are able to win is because Vanguard is reluctant to do those things.
It's finding new markets.
Yeah, like if you're Vanguard and you offer like a cybersecurity ETF, it's still an index fund. It just happens to be cybersecurity stocks.
Yeah.
Do it.
Do it.
Anyway, another reference to Starsky and Hutch for anyone that's unfamiliar. This ETF came out, and the reason why there's links to CBA is this is a dividend ETF. I think it's going to be super popular.
How much is in CBA? 12?
0.
0% in CBA.
Why? Because CBA
doesn't fit the valuation.
It's got a 2.7% dividend yield, CBA.
Ah, yes.
So how could you have something so expensive with a 2.7% dividend in a dividend ETF?
Because in the dividend ETF. Well, the dividend's growing. It did increase again.
Yeah.
Increasing consistently.
I don't deny that's a great company, but I just don't think, I'd rather just buy an ETF that is more diversified.
You don't hold CBA by itself.
No. Yeah. I'd probably buy Wesfarmers before that.
I did
probably
find
buy Macquarie Group.
What multiples Wesfarmers on? I reckon that's yielding 1.8%.
Yeah, but
it's testing a thesis here.
Well, Wesfarmers is like a
conglomerate.
Yeah, and it's going to benefit from lower rates because everyone's just going to go a bit spacco on the old. Oh my gosh, Bunnings is here again.
CBA's dumped all the bad loans off to other people. They don't lend, like all the non-bank lenders have taken on all the property loans, all the more challenging loans to stack up. And CBA, that's why they said something like 85% of their loans are ahead now. I don't even know how that happens. I assume it means they've got money in their offset account or something of that description. But they're only lending to the people with the best borrowing capacity.
Yeah.
And then they're using their technology edge to now pivot into business lending. That's why I still see value in them and wouldn't just outright sell.
No, I wouldn't sell it. I'm just saying I wouldn't buy it.
Yeah. So you're a hold.
If I have to be.
For once.
So here.
ETF flows, I've got that too.
Look, this is the way the capital markets have gone over decades. I'm showing on the screen for people listening the dividend yield of CBA and Wesfarmers side by side here on the ticker terminal. And it's gone from the average dividend yield on these companies was 5% in 2013.
Yeah.
So now the average dividend yield is 2.5%. In 10 or so years, the dividend yield has halved. In effect, the return that you're going to get has halved from the stock market. That has massive implications for retirees over the next 20 years.
But we're all out there buying up the ASX 200.
Yeah, it's because bloody Aussie Super's got $100 gazillion and it's just, buy CBA.
There's other reasons too. Yeah, that's one. There is one trend.
What's the other one? Give me the other one.
I do like this idea. ETF flows.
That's good segue, Drew.
The July results came through and record net inflows in July.
To Aussie ETFs, yeah.
5.82 billion in July. And that's the first time they've topped $5 billion.
Which is still small when you compare it to managed funds.
Yeah. Still nothing. And I think the total value of ETFs is still only 289 billion.
Yeah.
In Australia.
Which, it's a big deal. And we're starting to see more and more financial advisors, every day there's more financial advice groups and stuff just adopting ETFs.
Yeah. Even at the core.
Yeah. Yeah. Just in the core, if that's all they do. And so I think that number, we're going to look back in 5 years and go 289 billion. That was tiny.
Yeah. It'd be over $1 trillion.
Yeah. Yeah. It has to be.
And it's where all new flow, a lot of new flows are going into ETFs over other options.
Well, even when we have a financial planning client come through, we'll still use ETFs for their super.
Yeah.
Why would we not do that? It doesn't matter if it's a super account or a regular investment account, a family trust, you still use ETFs. They're still the best vehicle for most things, not everything, as we know, and we talk about a lot. So 1 trillion, says Drew.
I saw the 401ks. I found this interesting. So you see
it.
the news that came in the US, the executive order last week?
No, I did not.
So in the US, 401k is like your private superannuation plan. All the public superannuation plans we know about, the public PSPIP and Canadian pension plan, they're all massive and alts, but private pension plans like essentially SMSF and that kind of idea weren't allowed to generally invest into alternative assets. So private markets, private equity, private credit, crypto, and Trump signed an executive order forcing the platforms and the advisors to make available more alternative assets to 401ks. I thought that was super. And that's kind of, I know you've been posting a bit on LinkedIn, talking about private markets quite a lot. And I thought that was a massive step. We kind of have a similar problem here, but not.
You mean with the 2-day work week from the 2-day work from home thing?
No.
The government telling us what to do.
Executive orders, when it comes to alternatives, so yes, you can invest into them, but the kind of gatekeepers in our industry, the platforms, kind of limit your ability to accept illiquidity. Yeah, and they have to be approved on these platforms, and they are significantly better before you can add them to your superannuation investments. So that's
well, we had an issue with that actually. We didn't think that the PIMCO ETFs that we use were going to be available inside Net Wealth. Yeah. Because they actually trade on the SIBO. Yeah. So, but they are now, which is great. It's interesting. Yeah, it's interesting how that world works. Other news, rates coming down. We've already discussed that. JB HiFi, what did it do?
Tanked. Terry Smart, the comeback man, he's leaving again.
Really?
Chief executive.
Sad.
I think he left a while ago. They struggled a bit when Amazon came in, then fought off Amazon. Remember when we talked about Amazon coming in? I think maybe that was you and me talking about that too.
Amazon is life though.
Yeah. And basically, the CEO left. Result was actually pretty good, but I think there's some concern about leadership and how the company deals with new challenges with the CEO leaving. Dividends were positive, profit result pretty solid, and sales in Australia up 5% in July. So I think this kind of relates to rates too, I think.
CBA or JB HiFi? 10-year view.
What's JB HiFi look like?
There you go. It's right there on the screen. It's at a 52-week high, basically.
I reckon I'd take CBA.
Market cap $12 billion for JB HiFi.
CBA.
It has just because everyone's interested in this figure, a 5-year beta of 0.71.
They're on a very similar multiple.
What's the multiple?
29 and 27.
Oh, well. So JB HiFi's just had an absolutely stellar run. It's currently at $115 a share.
I'm comfortable paying that multiple for a defendable.
In 2005, it was $3.80.
Company.
This is a wonderful business, isn't it? When you think about it, underneath the surface, what it does. Price earnings ratio 27 times. I'd go CBA. Why? Banks are basically guaranteed to make money.
And defendable.
Yeah.
Like they can defend their position. JB HiFi has defended, but it's a lot harder on a low margin.
Yeah, definitely. Okay, it's a wonderful Australian business, wonderful retail business, probably one of the highest quality. You got like La Visa, Nick Scali, you got some good businesses on the ASX, but JB is probably at the top of the JB or Harvey Norman.
JB for sure.
I think there's a glitch in the matrix there.
Harvey Norman, like, why does that place? I better not say that.
Why is it still open?
Yeah. I was going to say, what do you think about the wealth effect, like linking to retail? So the RBA mentioned in their announcement that they, interest rates likely improve property prices. I know a lot of people say, wait for interest rates to be cut, property prices will go crazy. Even the RBA is like, we don't control property prices. I mean, they control the ability to finance and purchase a property, so maybe they kind of do. But improving, if we saw extra interest rates cuts, property, loans became more affordable again, and we started seeing property rally. Do you see the wealth effect happening? Do you personally, if your house is worth more, your mortgage repayments gone down, do you consume more, or do you think this is a bit of a?
Well, indirectly, I would, because like if our rate dropped on our mortgage or whatever, then I'd probably notice that there's just some cash sitting around and go find a reason to put some money into a boat.
Get a new boat.
That I never bloody use.
A farm, another turkey.
Yeah. No, I do see lower interest rates as an opportunity to leverage.
Yeah.
I don't know if you do, but I do. Like I think interest rates move in like 5 to 7 year cycles, and when the rates are in the right spot and you're looking to deploy capital, you should absolutely use them to your advantage. Absolutely. If you're in accumulation or in retirement. So like if you think about it, interest rates fall from say 4.8% or whatever they were to 3% in the space of 14 months, hypothetically. 4.8 to 3%, 33% reduction in the rate. That does a lot to your potential to borrow. Yeah. So,
what else? And Telstra. I think I was laughed out of the room on the Old Australian Finance podcast with you and Kate when I called Telstra a few years ago.
Yeah, you did call Telstra a buy.
Now look at it.
Wow.
It's nearly back to T2 prices. It's been on a tear, up from 360 to 490 in 12 months. I mean, it's gone from...
Would you buy it today?
The yield is down to 3.8, so I probably wouldn't be establishing new positions today. But I'm also not worried about selling it either. But it's finally Telstra's had this massive clean out that they've been talking about. Their costs actually reduced by 6%. Profit was up 31% on the year prior. And all those, they said, 2025 Telstra and 2030 Telstra, where they cut all the plans, limited them, kind of discounted them, and now they just increased the cost for the plans again while cut their admin costs and then increase the cost. Like, that's perfect. That's like pricing power. You just boosted your margin.
Remember when Telstra used to have 150 different phone plans? Yeah. And that's not hyperbole, they did.
That is like 5.
Yeah.
And they're all $120.
Yeah, wild. Absolutely wild. Okay, I think we've got to jump to some questions here, Drew. Because
it's supposed to be a Q&A, isn't it?
Yeah, it's supposed to be a Q&A. So I've already done the disclaimer, but just in case you don't know, you can send in your questions via the link in your podcast player in the YouTube description. Any of the questions that we do answer are strictly limited to general financial advice only. They're not personal advice because we don't take into account your needs, goals, or objectives. We ask you for a funny name and try and keep the details a bit light in your question. That way, better chance of getting on the show. Second of all, it also means that we can be a bit more liberal in our responses. And so the first question comes from Pablo. Pablo writes in, I want to invest in gold, but not sure if I should go with hedged or unhedged gold. Unhedged has lower fees, but seems more volatile. This is for the long term. Thanks. Thoughts?
I wouldn't be too worried about the cost of buying your gold. You're buying a hedge, and I think a key one is understanding what position size you're going to put in. How big does it have to be a proper hedge? But yes, if you buy gold unhedged, you're exposing yourself to two risks. The price of gold So gold's priced in US dollars, but also the exchange rate between the Australian dollar and the US dollar. So it naturally will be more volatile because it has two inputs. We have a general rule, which is that your hedging policy is based around the long-term average of the currency. And we're in that kind of weird spot at the moment where the average is from memory, and it obviously changes. The longer it's lower, it gets dragged down. It's around that 71 cents from memory, and we're sitting about 66. I like looking at the chart on currency because the scale of it makes it look like it's volatile, but it's moving from like 68 to 66 cents in 12 months. Like it's barely moved. Even the biggest dip was down to 60 cents. So generally our view at the moment would be to remain unhedged, even though it's slightly below the long-term average. It's close enough to it. I think if we started to look above the long-term average, then you'd look at incrementally adding your hedging position, which removes the currency, which means the Aussie dollar gold price, $5,000 is what you're getting.
Yep. Okay, cool.
The weird thing is the news always talks about US dollar gold price and doesn't even mention Aussie dollar gold price.
Yeah, never. We do 50-50.
Yeah.
Keep it simple. We want the gold price exposure. We're happy for a little bit of US dollar exposure, but we do want the gold price exposure. So we do 50-50, keep it simple. I think we do use GXLD from GlobalX and GHLD, the two ETFs, super low cost.
Yeah.
Hedged, unhedged.
And then there's
QAU from Beta Shares.
GLDN from iShares.
Yes, and then there's GOLD from GlobalX, and then there's PM Gold from Perth Mint. Yeah. They're the big ones. And then there's NUG from VanEck as well.
Yeah.
That's a good question. Next question comes from part-time listener, long-time investor. Lads, GlobalX has just dropped A300, which is much lower cost than VAS and seems pretty much identical. What do you think about it? Is it a good addition to portfolios? Also, why does Drew drive a four-wheel drive if he's never had dirt under his fingernails? Oh, he does.
One of the things I always seem to be able to do is get dirt under my fingernails. You can ask my children, my partner. It's one of the most annoying things. The thing is, it's not from doing any dirty work. I just don't know where it comes from.
It's an odd unit. A300 is lower cost alternative to VAS. VAS will probably lower its fees through time. It's good to see competition. I don't see a lot of people switching across to VAS, but
the incumbency is hard because so many people are sitting on capital gains. So why would you switch an ETF if you're sitting on a capital gain? You have to realize a gain. But it might be that, and then incrementally, unless you're investing a significant amount into these ETFs, the cost isn't like if you're looking at institutional level, the cost would be big if you're putting $1 billion in it, but it doesn't actually change the outcome all that much.
Yeah.
3.03%.
Here's a question for you.
I probably shouldn't say that, but I think it's kind of...
No, it makes sense. I think that it'll just collect a lot of new money. Or if you're in retirement phase and you don't have capital gains tax, you might be inclined to switch.
You might add this as your new one.
When you do your rebalance, you might use this one instead of that one.
I've always preferred the 200.
I'm here on the GlobalX website. What proportion
12%
of the Australian share market, according to the A300 ETF, is in financials?
37%.
34% in financials alone.
17 in materials.
18 in materials, close. That's like
52% in two sectors.
Yeah.
And two of the most boring, old-fashioned sectors in the world.
Cyclical, but they're almost counter-cyclical to each other.
And materials, that 17% is almost all in iron ore.
Yeah. Yep.
That's
BHP, Rio, Fortescue. Okay, so we've probably got time for maybe two more questions.
I like the dad joke that was sent in.
Okay, yep, here we go.
Maybe I don't. Actually, that seems a bit inappropriate.
Collins Street Bets. Hey.
This is a play on Wall Street Bets, isn't it?
Yeah, I think so. Wondering if you and Drew can answer this question on the Saturday morning show, the best show each week. We actually had a lot of critical feedback to last week's show. I think we were just so eager to talk to each other that we talked over each other.
On YouTube or?
Yeah.
I haven't had a look.
Yeah.
Can we go through some of those or do we have enough time?
No. How would you recommend someone rebalance a portfolio? They say, I have 10 different ETFs.
Worse than when we play golf.
10 different investments, ETFs, physical bullion, crypto, and wonder how often is a good time to rebalance and how is the best way to rebalance. Do you want to read that dad joke?
No, I think I'll save it up and get a new one.
I can read it.
You can read it, yeah.
Google is a bad influence. I searched how to become an arsonist. It gave me 50,000 matches. That's a good one. I like that.
You like that one more. That's a bit unfair.
Yeah. So 10 investments is typically easy. However, in this general circumstance, Collins Street Bets says that they have ETFs, physical bullion, like actual gold bars, and crypto, which is probably cold or hot storage crypto. So
whatever that means.
Effectively, whether you have it on a hard drive or you've got it in like an account, like Coinbase or something like that. So it would be tricky to track those.
Yeah.
Interestingly, actually, just thinking about Navexa before, you could actually put the amount of gold that you have into Navexa as an investment in one of the gold ETFs. So you can track the relative price of it. That'd be cool. You can do crypto in there and you can do ETFs in there.
You can just put on ChatGPT and
you could probably do it there
and ask ChatGPT to remind you to rebalance it every quarter.
True. Grok even.
Yeah. Try that one.
So you want to have what we call strategic asset allocation, just a broad mix of what you think you're comfortable with for each thing. And then you can have like a reminder, as you said, or you can use one of the platforms that allow you to auto rebalance. BetaShares Direct, I think, does it. Perla definitely does it. I don't know if any others have automated rebalancing. We do it at Rask, obviously, for you. But I would just say, first of all, get your head around tracking the portfolio. Second of all, decide on the asset allocation you want, and then have a tolerance band. Maybe it's like 10% or something like that.
I think that's a perfect approach.
Yeah.
Set it and sit down and review it. I just came up with that ChatGPT now, but I think that's actually, you could set your SAA. Yeah. Set your SAA, have it in a document, give it to chat and say every 3 months, remind me that I need to rebalance.
Yeah.
And rebalancing, we've done the data with Atchison, which is our asset consultant, and the people help us manage our investments, which is rebalancing is one of the biggest contributors to outperformance and alpha.
It is.
And the time, you can't time the market perfectly, but it helps you sell parts that have gone up to buy parts that have gone down.
Absolutely. Like we saw that during Liberation Day, right? Yeah.
And when you dumped 100 grand in.
Yeah.
Well, the feedback wasn't that bad. There was one. It was like, keep up the humor. This is what makes Drew and Owen the most entertaining duo in finance. Then, too much off-topic discussion. We come to this channel for targeted financial content that will educate us more than our alternative media channels. And then someone responded, have a whinge. What meaningful impact have you had to the finance world in your life? Is that suggesting we've had a meaningful impact on the finance world?
Oh, maybe.
I hope so.
I hope not.
That's what I stay up worrying about.
No, that's true. There's a lot of, the Rask community is awesome, isn't it? As is the Waddle community. It's actually just cool. Yeah. There's different perspectives, but it's always great to have a bit of banter.
I was talking about this last night, which is, it's not anonymous. Like the people on social media think it's anonymous when they make comments like this, but it's not anonymous. You feel anonymous, but your name is there. Fun times. Sorry.
The best ones are those Facebook accounts without a display picture. Hold your horses and shares, and they did that first ever emojis in the chat in their questioner name. Here we go.
Usually means it's created by ChatGPT.
Is there a business out there that can organise everything? For example, if I wanted to do debt recycling strategy, could an advisor coordinate with the broker, tax agent, etc., to make it happen? Yes.
Yeah.
Financial advisors can do that. They won't apply for the loans for you, but they are your project managers. There are other areas, like debt recycling is more so an accumulation type strategy, which we're big advocates for. But in the retirement community, there'll be a lot of things that you need other experts for, like estate planning, overseas assets.
Insurance store thing.
Yeah, insurance. Yeah. I imagine you'd rely on third parties for those types of things.
Yeah, I know there was like a tendency to move towards all-in-one, like where you could come in and you get all your mortgages done and all your insurance done and all your everything done internally, and it works in some cases.
Some businesses it does.
But most of the time it doesn't. You just you're a master of none, like you're jack of all trades and you can't master any. So your advisor, good financial advisors, I think these days are the project manager. Yeah. They'll do the work that means you don't have to re-explain yourself to 3 other different experts. Yeah. So in this case, if someone wanted to do debt recycling, we'd introduce the mortgage broker. They take care of that part. Yep. We'd take care of the opening of accounts and investment of money. And then we can introduce an accountant that suits that person and find someone that's suitable.
Yep. Final question, actually. Kerry Taxa, they write in. We're a couple in our early 40s and we're 2 young kids aiming to retire in 8 to 9 years. Our home and 2 investment properties are paid off and we have a healthy share portfolio and super funds. We're in a very cash flow positive position. We're not interested in evading tax, but we're not looking at donating extra. So the generalized question, which if I may, I will generalize this one, is we've been dollar cost averaging and are thinking about debt recycling. Do you have a different view on timing the market with debt recycling when someone is already investing each month? So the question here is, does debt recycling, which we've had 2 questions on this now, I think about it. So debt recycling, for people that are unfamiliar, is basically redrawing the equity out of your house or an investment property and then using that to invest in shares. It's similar to just buying another investment property, except you redraw the loans and the money goes to shares. And hopefully if you set it up correctly and get all your advice, it can be tax deductible interest on the loan, at least that component. I don't think for a geared portfolio, there's any difference in the way you should approach a portfolio. Maybe somewhat more conservative and focused on income. So you get that, you make sure the tax deductibility is there, because you have to make sure that the investments are right for tax deductions. Anything else you'd add?
I think this kind of depends on the nature of the person. Clearly, these people are comfortable with...
Done a very good job.
Yeah, in a great position. But they're clearly comfortable investing in shares.
Yeah.
Like if this is a person that was becoming brand new to investing in listed markets, you'd go to follow the Scotty Carmichael approach, which would be, let's not put it all in at once. Let's step it in over a period of time, because we don't want them to have a bad experience, freak out, and then sell.
Yeah.
But I think and then it would depend on the quantum. Like if you've got $1 million and you're adding $1 million to it, I think that would warrant a stepped approach. But if it's a portion, like a less material portion of your wealth, you're fine to go and buy it. But again, like the question at the beginning, I wouldn't be buying 2 ETFs with it.
Yeah, you'd be diversified as possible.
You'd be buying you're not just buying the S&P 500 or the ASX 200, you're buying a range of hopefully resilient income and growth sources.
Yeah, definitely. This is a great question, by the way, Kerry Taxa. But might as well, if you're in that financial position, get financial advice. And then that way you don't feel like you're kind of, you've got a passing interest, or you're not sure. Like a lot of the people that we deal with, Drew, their financial advice is more so along the lines of validation. Like, am I doing the right thing? Have I missed anything? And that's worth the few grand you pay for financial advice. So go and check that out. Now, we do have one thing that we do need to get to, which is your dad joke, and you seem to be giggling already.
Looking at these comments.
Go on. Was this on your YouTube channel?
No,
or
your one. Your one.
Oh, gosh.
Calm down, Michael. It's Saturday. Hopefully Michael's not listening right now.
If you are listening, Michael, direct all of your anger towards Drew at Waddle Partners. Andrew at Waddle Partners. But you got to give us a dad joke. If you do want to work with Drew, waddlepartners.com.au is a place to go. You can find out more about Rask, including our financial advice business, on the Rask websites. And also enroll in a free course. Come say good day in the community. Over 2,000 people in the community already, and it's growing faster every day. So we'd love to see you there. Come have a chat. Drew, what do you got for us?
Why don't skeletons fight each other?
They're too bony?
They don't have the guts.
That's pretty good.
Thanks, ChatGPT. Credit to Sam Altman.
Thanks, Sama. And also Elon, who's apparently more reasonable according to OpenAI. So you see, there's a big fight going on at the moment between Elon and Sam Altman.
Yeah, I saw that.
Founder of ChatGPT and OpenAI, on Twitter/X. And so then Elon went into ChatGPT and asked it, who's a more reliable and trustworthy person, Sam Altman or Elon Musk? And it came back with Elon Musk. And then he shared that with the X community. He said, there you have it. Even his own AI won't say that he's more trustworthy. But it's been heaps of fun. Drew, Meredith, absolute pleasure. So thanks for joining me.
Good to see you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.